Hi, I'm Pattu from FreeFinCal, and let's talk about how to define a financial goal in this video. So let's do this step by step without using any calculators. In the next part, we'll do a calculator based illustration. So the first step is to be clear about what your need is. Why are you investing? What is your ultimate aim? What is the product that you want to buy? What is the service that you want to buy after, let's say, 10 years, as an example. So the second part is I've already mentioned it. You need to be clear about when you need the money. Some people say I may need it after 2 years, I may need it after 5 years, and so on. If you're not clear, you cannot decide where to invest. If you are not clear about when you need the money, then you cannot take risks. So it's better to be as clear as possible about when you need the money. Then only you can decide whether you can take a risk or not and where to invest. So what the goal is, when you need the money. The third is, what is the current price of that product or service that you are looking to buy. For example, let's say it's your child's college expenses, and what is the current cost of a UG degree, what is the current cost of a PG degree. Then after 10 years, when you need the money for the, let's say, the UG education, how much would the current cost increase after 10 years? So you need to assume some rate of inflation so that the price increases year on year smoothly. Of course, in real life it is not increase smoothly like that, but you have to project it like that anyway. I would assume that for a product, for any product or service in India, take 10% inflation. Anything less than that is dangerous. Lifestyle and managing expenses, that's a different matter. You can take it slightly less. But if you're looking for a product like buying a car, or buying a bike, or starting a business or child's education and so on, take 10% flat. Don't ever compromise on that, otherwise it'll be a problem. So for a 10-year goal, if you assume 10% inflation, if X is the amount that you need today, roughly you will need 2.6 times X after 10 years. So that's your target corpus, right? Now the next point is a little bit tricky, and this point alone requires explanation in a separate video. So let me make the assumption and tell you the number, and I will explain this in the second part. So for a 10-year goal, I have assumed 8% inflation. So my minimum return after tax should be 8%. That's my minimum return. If I can, if my entire portfolio after taxes is equal to 8%, I would have matched inflation. So that's my minimum requirement. I can try to beat this inflation number by a little bit. So I can assume about 9% return after tax over 10 years. Now this is where it gets tricky. Why is it 9%? Why are you assuming so low number? It's 10 years, no? Many people think that they will get 10%, 15%, 20%, and sales guys also assume such numbers routinely. Why have I assumed only 9%? And at best you can assume 10%, even that is a long shot for 10 years, I think. So this is where it gets a little tricky. I will explain this in detail with numbers in the next part. So what I have done is to assume that we are going to invest in two asset classes. One is stocks or equity, the other is fixed income, bonds, debt mutual funds, fixed deposits, and so on. I am assuming a return of 9 to 10% or maximum 10% after tax from equity, and 6 to 7% after tax from fixed income. So these two are the return expectations. And for a 9% to 10% portfolio return, I will need about 50 to 60% equity allocation. The portfolio should have 50 to 60% equity allocation, at least initially. The rest of it should be in fixed income. So, but I cannot have this much allocation for all the 10 years. I have to reduce it because it's too risky to hold that much equity. So I'll have to reduce the equity allocation as the goal deadline approaches. When the equity allocation reduces, the return will also reduce, expectation will also reduce. Therefore, I am assuming, taking into account all these factors, I am assuming 9% return after tax. This is only an assumption, I need to check it. But it's possible to do an exact calculation, much more exact calculation, I would say. Not, you cannot assume that everything will turn out the way we wanted, but we can do a much more exact calculation than what I'm just told you. We will do that in the next part. So I'm assuming 9% return after tax, and for this 9% return, given that I need a target corpus of 2.6 times X after 10 years, how much should I invest each month? And I can also take into account that I can increase the investment year on year by 3 to 5% because my salary will gradually increase also. So taking into account what should be my initial investment in this portfolio. That is how you plan a financial goal from start to finish. So you cannot simply ask, shall I invest here, shall I invest there, shall I have buy a mutual fund, start a SIP. That kind of random questions will give rise to wrong answers and wrong investment decisions. So it's very simple to plan a goal systematically, and let's get into details in the next part and actually do a calculation. I'll catch you again later. Bye bye.